Welcome, everybody. I hope everybody's having a great evening and looking forward to spending a little bit of time talking about numbers and hopefully giving you a few ideas to help, make things better in terms of financially in your businesses. The agenda, we're going to talk about some of the basics that every dentist should know, but maybe most were never taught. The real cost of running a dental practice, choosing the right business structure, sole prop, LLC, S corp. What's missing in most dental practices, the cost of inefficiency is an interesting topic. Also, maybe some ideas on strategic tax planning and changes the game for dentists and how that can work. It's also not a static process, but it's a policy process. And then, talking a little bit about some of the dental impacts from the One Big Beautiful Bill that passed in July, a little bit of introduction on One Big Beautiful Bill, and kind of some of the things that changed and what dentists can expect from that particular situation. Obviously, taxes are a big part of everything that we do. So, financial basics, but most were never taught. Let's talk about that. I think when you look at a dental practice and really compare it to, kind of running a business, right? It's a very, very different mindset, right? Right, the dental practice and really is taking care of the clients, making sure everybody's healthy and good. But on the dental business side, you also have to have that duality of thinking about your ownership, right? And your focus, is patient care and clinical outcomes, making sure you have the best possible outcomes. But also you got to think about profitability, sustainability, and strategic growth. It's challenging, for almost anybody in any business to think about two things at the same time, right? So, a lot of times when we're talking about financial awareness, sometimes when you're just focusing on your practice and not really thinking about the owning the business side of things, you're a little bit reactive, right? You maybe rely on your accountant during tax season to kind of get out there and give you the numbers, fill out the tax forms, get it done as quickly as possible because you got clients to get back to, right? And you have patients to take care of and everything else like that, and staff to deal with and everything else. When you're in a we're thinking about the dental business, you probably want to be a little bit more proactive, using financial reports to make decisions. I'm going to talk a little bit about that as well, and thinking about some budgeting and projections and stuff like that, so you can figure out, what's the best thing to do. Tax strategy, a lot of times, if you're just doing the practice side, you may be overlooking that or not really thinking about it, or maybe using some general terms. But the real truth about tax strategy is that it is structured with planning and legal strategy in mind, and it has an impact on where your life is at. You might have kids in college, you might have young kids, you might have, your wife may be working in the practice, your husband may be working in the practice, they may be doing the marketing. Lots, so many. What I really like about tax planning, quite honestly, is the fact that it's always a puzzle and everybody's life is different. And trying to integrate that life into your business is also really, really very interesting. Compensation, sometimes if we're just running a dental practice, we'll just take a draw without a strategy to how to take the payroll. When we're running as a business, we're paying ourselves through tax, efficient methods like salaries and distributions, trying to make sure we minimize our self-employment taxes if we're using an S corp or whatever else we need to do. Dental practice on decision making, sometimes it's based on urgency, whatever we have time for, or we're doing intuitive. When we're doing it as a dental business, it's really thinking about the financial data and the forecasting. What's this going to mean for me bottom line wise, right? The growth approach, we're adding patients or services without maybe scaling support. We're doing it from kind of a rule of thumb. Sometimes we maybe talk to other colleagues and we say, okay, what did you do and how did this work? And what's kind of the rules of thumb or what should we do? And a different one in the business side, maybe we're planning a little bit more, the team, the systems, the resources to grow profitably, and making sure we have the money in place to do that. Exit strategies are really, really important. Okay. I've seen dentists and I've helped dentists through exit strategies where they sold their business and sometimes the building that the business is housed in, right? So sometimes it's undefined until retirement. And hey, I'm just going to sell this when I get there, right? But other times the exit strategy is planned years in advance, with proper financial positioning, making sure because there's some strategies you can use where you can basically get uh, uh, tax-free treatment and up to $10 million of capital gain, which could be really, really interesting. And, if you're in a state like, California, New York, Illinois, the high tax states, it could be like 33% of your gain could be taxed. You know what I mean? So use of advisors, sometimes, the dental practice will just hire a bookkeeper and tax preparer, just get the numbers done, whatever, we'll take care of it. But in a dental business, you're kind of looking at a different approach. You build a team, a CPA, tax strategist, financial advisor, business coach, whatever you need to get the information to make the best possible decisions going through. So it's a totally different focus. And sometimes it's hard to balance these focuses, but one that I think you need to be aware of. Oops. There we go. Really based on, ADI, Health Policy Institute, and the Journal of Dental Education, this is kind of one of the reasons why some dentists struggle with finances, right? There's basically a lack of financial education in dental school, right? High student debt and startup costs can also be very, very difficult. It's expensive to become a dentist, right? Over reliance on accountants after the fact, meaning you get through your year, here are my numbers, what are we going to do? Instead of planning in advance, right? And really no formal tax planning, limited business training, and fear or avoidance of financial topics. Sometimes, as a scientist, as a dentist, as a medical professional, or somebody that's there to care for people, uh, numbers are scary. I mean, our numbers are different. You know what I mean? So, on the other hand, I have dentists that I've worked with that are frustrated accountants, and they love to run their numbers, and they love to do stuff and look at stuff. So it's a very interesting um, diversity in the dental profession. But this is kind of why some dentists struggle with finances, and really these reasons are kind of all interrelated, but it's very, very interesting, right? One of the things we can do to help ourselves, and this is kind of an example, and I'm gonna send with copies of this program. I'm gonna send a format of kind of some. This is basically a 12-month trailing, an example of a 12-month trailing cash in, cash out, like balance sheet or income statement rather, to kind of show you how much money you're making every month, how much cash you're bringing in, what you're spending, so you can look at what your bottom line is each and every month, right? And kind of reconcile this. This is a pretty interesting way to look at it. And when I say world-class reporting, so many businesses look at a trailing 12 or a forecasted 12, right? So if you're running a business, I think, and this is true of any business, one of the best things you can do is look at your trends of like, like when you look at your purchases, month after month after month, or you look at your dental supplies, or you look at your wages month after month, and just look across, right? You say, oh, that's interesting. This changed. I wonder why. And then you can go back and look at the detail or remember, oh my God, I had to hire three more people because we had some sort of, some people on vacation and, there's a lot of different reasons. Or like here, events or advertising or marketing, you did some big things to spend some money, and then you can look at, whoops, sorry, we can look at like what that impact was to the bottom line in that particular time. You know what I mean? That is looking at trailing 12s and forecasted 12 months. Uh, it really is a great education and such a way to spot trends, right? So you can, my revenue was up in January because of whatever I did. I did a special promo, right? Or people had, one of the things that happens a lot of times is people have are run and they have to spend their money at the end of the year to take care of their stuff because their dental program renews on January 1st, right? Or sometimes people wait until January 1st until their program renews to get their work done. So, it all depends, but it's very, very interesting. And to have that kind of just basic knowledge of how the numbers are running makes you super empowered. And once you get used to it, it is not really that challenging to sit down and look at that for 15 minutes, a half hour, an hour at a month end and say, hey man, okay, what happened this month? Okay, what do I remember? Oh, this worked or that worked or whatever. Business in general, when you really, really boil it down, is pretty simple. Find out what works and do it over and over and over again. It's basically it. Like, find out what makes you money. That's the tricky part. And then figure out how to do it over and over and over again. And the tricky part is understanding the numbers. Um, and it's really, really important. So the cost of running a dental practice, right? So really, staff salaries and benefits, often the largest expense. A lot of times 25 to 30% of 35% of revenue, right? And just depends on where you're at and what the locations are and everything else. Office rent or lease, again, location based, typically 5 to 10% of revenue. Dental labs, supplies and labs fees, 7 to 10% of collections, which is revenue. Higher for specialty practices. Equipment and technology. A lot of time those startup costs are around 200K. They can be a lot more if you add more business or add more equipment or get into specialty stuff. Marketing and advertising, website, SEO, paid ads, community outreach could be 2 to 5% of revenue. So it's not just about the clinical excellence. It's about knowing how the numbers flow and what you should be expect. Like if we add all of these up, we can kind of figure out, okay, how much should my bottom line be, right? So if the 35% and the 10% and the 10%, 45%, that's 50%. Then you have some other costs, right? And if you look at those as a percentage and look at a percentage of your collections or what your overhead is, you can pretty easily figure out what your break-even revenue is. And break-even revenue is really, really important. Is that point where you're actually making more money on every sale, right? Software and subscriptions, practice management systems, we have to invest in billing, scheduling, etc. Professional services, legal, accounting, compliance consulting, also very insurance and licensing, malpractice, liability, disability, workers' comp, renewals, right? CE, you have to have travel, tuition, and materials to maintain your continuing education. And then loan repayments, we should build in there and really kind of build it into your cash flow so we can really understand. So many times when you get a straight up profit and loss or balance sheet from your accountant, it doesn't include the impact of your loan repayments. And that's why I really like that cash in, cash out schedule that I showed you before, because you know what your true cash in and out of the bank account is going to be when you look at that. And that's a great budgeting tool for the future, right? Um, so I really kind of like that because a lot of times, those debt repayments are not included, right? Then, of course, we have the very dreaded federal and state income taxes, up to 37% on federal, up to 12% in some states. Self-employment taxes could be 15.3%, especially if you're operating under a sole proprietorship or an LLC. If you go to an S corp, you can split that and drive that down a little bit by splitting your income between wages and distributions from the S corp. So it's a way to save money. Retirement contributions, I think one of the things that's really, really very, very important as business owners is to plan for the retirement, not just to plan for, hey, I'm going to sell my practice when I retire and then I'll have plenty of money. Okay. We don't know what's going to be out there 3, 5, 10, 20, 25, 35 years from now, depending on what level you're at in the practice or what you're going to do. We just don't know. You know what I mean? It's not smart to just, put all your money on red and hope that the roulette wheel hits you right. You know what I mean? You want to have a multi-point strategy to save money for your business, right? And then you also want to budget for some unplanned or seasonal cost, equipment repairs, travel, CE, travel, team bonuses, legal costs, or whatever could possibly be, right? Um, so when we think about what is left, okay, we got to think about issues like we got to take care of taxes, right? Your remaining net profit is significantly reduced by your income tax obligations. Federal can be up to 37%, state can be up to 12%, depending where you live. Practice owner, you need to bear the full responsibility of self-employment tax. Retirement contributions at year end are going to be really, really important. You can take owner distributions and business investments. So let's say you've been doing well and you've generated some cash flow. And that cash flow you want to reinvest in other things. Like maybe you want to buy your own building or start to invest in real estate or start to invest in other things, and you make commitments to make those investments. There may be loan costs that you got to think about and to plan those distributions going forward. And then obviously unexpected costs. I mean, there's always going to be something. We all know that. That's how business operates. There's always something. Choosing the right business structure. Okay. Um, Dentists sometimes form a business entities just to check a box when starting their practice. The entity structure is not just a legal formality. It's one of the most powerful tools you can use to control taxes, reduce liability, and build long-term financial health. How your tax sole props and LLCs by default pay self-employment tax. S corporations allow for some strategic tax splitting of self-employment tax. You can take some wages and some distributions to avoid some of those self-employment tax. And the interesting thing in the big beautiful bill, that QBI deduction that we can use in an S corp goes from 20 to 23%, plus also your state and local tax deduction that was limited to $10,000 now goes to 40,000. So we have some interesting opportunity. Your liability, right? Sole proprietorships, there's no liability protection whatsoever. You are fully liable. All of your personal assets are exposed. LLCs and corporations, S corps or C corps, can help you protect your personal assets, right? Take-home pay. S corps allow you to split your salary, so done taxed normally, and distributions that are not subject to self-employment tax. Typically, you can cut your self-employment tax in half if you handle that right. S corps and C corps can unlock more benefit deductions, healthcare, retirement, fringe benefits, etc. Generally, C corps are even a little bit better than S corps, but it really depends uh, on how much money you're making, whether you should be an S corp or a C corp. C corps are very, very good for people that are raking in a ton of profits. S corps tend to be better when you're in the mid range and maybe even the lower range in a dental practice. So, like as you're growing, you can be an S corp and take advantage at least of the self-employment tax savings. And as you get bigger and bigger, let's say you start opening other offices, C corps might be more beneficial, right? Your retirement options, corporations can sponsor higher contributions plans like SEP IRAs and solo 401ks, and even defined benefit plans. So, if you're making a lot of money and you want to put more away, it's really, really important, right? Audit risk and compliance. Poorly managed sole proprietorships are likely to raise red flags with the IRS. Absolutely true. The rate of auditing sole proprietorships is about 4.7% by the Internal Revenue Service. They're not auditing a lot right now because of staffing issues, but it is the highest risk because the IRS perceived it gets the greatest reward. Most of the time when people are sole proprietorships, they the IRS perceives sole proprietors to not save their data, not be very good at managing receipts and everything else like that. And they audit you the way they've always audited. And they've done this for almost 100 years, right? Where they'll come in and say, I want to see all the receipts that add up to this number on your tax return, right? And you pull out your general ledger then they want you to pull out the actual receipts and canceled checks for those numbers to prove that they're really there. Well, if you don't have that stuff, if you don't have your general ledger, you don't have your detailed receipts, you don't have copies of canceled checks and or any payment. Let's say you pay it with a credit card, that's fine as long as you can tie it out. But the credit card statements themselves will not suffice to generate or to validate an expense in an audit. They want the detailed receipts. A lot of times that's pretty easy to do, right? So in the dental business, like all of your supplies and the dental supply houses that you work with can send you an annual summary, you know what I mean? Or they can send you additional information. Your lease is pretty easy to prove. Your payroll is pretty easy to prove because you have your W-2s and you have your 941s. And as long as you handle all that stuff correctly, that's great. Your marketing stuff might be a little bit tricky. You need the invoices for that. And then entity exit and succession planning. Structured entities like LLCs and corporations are easier to sell and transfer ownership. whole bunches of different things in selling something that's a corporation. You have the possibility of an asset sale. You have the possibility of a stock sale. It all depends on how you want to handle it. And then, like, if you are a dentist that decides at some point in time to own their own building, and let's say you want to sell your practice, now you're selling the building with it, that also gives a lot of opportunity to do some interesting things with taxes when you're doing a sale like that. Like how much is the building worth, and how much is the building worth with the practice in it, and how much is the practice worth, right? So there's some really interesting, like from a tax perspective, I'm not talking about from a sale perspective, really interesting questions that can be asked and some interesting twists that can be put on that to save you money. I went through this with a dentist client of mine in the sale of their practice. They sold the building along with it and actually sold it separately. Very interesting that we were able to sell the building in 1 year and do a 1031 exchange to other real estate to avoid capital gains there. And then in the next year, they actually sold the practice, right? So there's like, it's always great to have those options to kind of, spread things out versus, if you sold the business and the practice in the exact same year, you might have higher taxes because, you got the Obamacare tax and the net investment credit tax that can kick in depending on the level. And a 1031 exchange from a real estate perspective lets you avoid capital gains altogether. So it could be really, really interesting stuff. Uh, but what's left? It's not all yours yet. Sole proprietorship. We already kind of talked about this. Kind of the tax treatment. We talked about it. The pros and the cons. So, like we talked about tax, but the pros are like, so it's easy to set up. There's a low cost of doing it. But you have high tax liability, no liability protection. LLC, self-employment tax on all profits. So it really doesn't get you anything from a sole proprietorship except liability protection and gives you flexibility with an LLC. An LLC can actually, you can elect to get it taxed as an S corp or a C corporation, right? So that's pretty interesting. Still taxed like a sole proprietorship. So LLC tax as an S corp, salary but distribution model, lower self-employment tax, tax deductible benefits, requires payroll system and compliance efforts, right? S corporation is really the same, salary plus distributions, maximizes tax efficiency, ideal for a lot of dentists. S corps are what a lot of dentists use, right? So must file formal payroll for yourself. You definitely got to do that. C corporation. If you don't handle a C corporation correctly, there's a potential for double taxation. But C corps have, they generally have a lower tax rate overall. They also, there's a couple different things that are interesting with a C corp. Lower tax rates overall, 21% versus 37%. Um, you also have the ability to not have a passive loss restrictions on real estate that you might invest in. A lot of dentists, as they become successful, start to invest in real estate. And they want to take some of those real estate losses, from depreciation against their business, but they can't, right? Unless their wife or husband is a real estate professional, then you could definitely do that. Um, and then there's the 1202 election, which lets you sell a C corp and possibly avoid $10 million of capital gain. So it can be really, really interesting if you set it up correctly, right? So if you just want to take all the money out and go, take all your distributions out and all your profits out right away, and you want to use them to do non-business things, play, go to Vegas, travel, whatever else you want to do, you can definitely do that, right? C corporation is more complex, and you can get double taxation of dividends if you want to take all that money out. A lot of CPAs just assume that that's the way it works, and it's not necessarily true. A lot of different ways to do things, right? Um, Whoops, hang on, I went backwards. What's missing in most dental practices? The cost of inefficiency, right? Uh, Common inefficiencies that drain profits, expense tracking. This is why I talk about, the 12-month tracking. If we have no clear categorization of supplies, labs, continuing education, or marketing expenses, we're not keeping track. We're not looking at our books on a monthly basis. We and we don't really put our books together. You are going to miss deductions. You're going to have messy books. You're going to have audit risk. And honestly, I've never seen somebody maximize their success who has not had good financial records. Because that discipline of finance, it's like anything else, any other discipline. That discipline of financial records is makes you financially healthier. Just like if you sat on the couch every day and didn't get up and exercise or move around, you're not going to be physically healthy. It's the same financial situation. You're not going to be financially healthy if you don't put in the discipline of keeping your books. Payroll and compensation, paying self or associates without tax efficient structure. I mean, sometimes people are like, you know what, I'm just going to hire them at 1099. I'll just pay them hourly. Again, discipline of scheduling, discipline of making sure you're paying people right. And then your charges are the right percentage of, you know, or the billing is the right percentage of what the payroll is, right? This could lead to higher payroll and problems, self-employment taxes, and overpaying the IRS. I've seen people who make this mistake before, where I'm just going to hire this person as a 1099, even though they're really an employee. Then the labor board catches up with you, and suddenly you have fines and penalties that are astronomical. And, it could be a problem. Tax strategy, year-end filing only, no proactive planning. Surprise tax bills can lead to surprise tax bills and unnecessary overpayment. Uh, Cash flow management, no system for timing income of expenses. Could cause cash crunches, especially with insurance reimbursement delays. We could be worried about when that money is going to come in and how's it going to come in. And it's just, you don't want to lose sleep over time, cash flow timing, right? Taking draws without considering the benefits of retirement, owner pay and benefits. That's another thing that could be missing. And then you could lower your net income, cause no wealth building, and create a higher personal tax building. And then exit planning again, no roadmap for selling, retiring, or succession. And you want to plan that pretty much in advance. I would say a good 5, 6, 7 years when you're thinking about doing this. You want to start exploring, right? And figuring out what's going on and what you can do. How strategic tax planning changes the game for dentists. This is like saving money on taxes, which is a big thing that I do. Again, same type situation where you're looking at um, the possibility of not structuring your pay properly, not taking advantage of all the possible loopholes you can take on income strategy, pay full self-employment tax and tax liability. So without tax planning, you're looking at facing some serious problems, missed deductions, poor documentation, often skipped or underfunded retirement savings. You, man, sometimes people actually pay certain things out of their personal account, which should really come out of their business account. I've seen it all the time. Like healthcare and benefits, right? Quarterly tax estimates, if they're not paid right, you can get into penalties and underpayment penalties with the IRS and your state tax authorities. Disorganized books, unclear deductions so when we really have no discipline here, again, I'm talking about this again, that's trouble, right? But when we do it, when we do strategic tax planning and when we really look at what we should be doing, right? There's a tremendous amount of opportunity, right? Typically, like when we actually implement tax planning for somebody who's not done it, we can reduce their taxes by 40% on average, right? Because we're using every single loophole we possibly can. We're making sure that they have the right structure. We're asking them questions about their business over and over again. Okay, how do you pay this? How do you pay your kids? How do you pay your wife? What else? What else? Where do you pay this from, or where do you pay that from? A lot of it is just making sure that you're paying everything out of the business you should, right? And tax planning is not static, it's shaped by policy, right? Every year, Congress passes tax related laws, right? How much dentists pay, what they can deduct. It impacts all of these things. Which benefits and retirement tools can they use? How they must report and structure income. And these laws change through new legislation like the One Big Beautiful Bill, IRS guidance and enforcement updates, sunset provision and phase out clauses, state level tax law changes. So, I mean, there's a lot of different impacts to your taxes that had, right? That taxes that you have to pay. Um, Laws that affect dentists year to year. And we're going to talk about a little bit about this, right? So standard deduction and tax brackets change every year. They get adjusted by inflation, okay? And it affects how much income is taxed and at what rate. Self-employment tax thresholds also and exemptions can also shift, right? Impacts for net take home and solo dentists or partners can make a big impact. If you buy equipment, right? Section 179 and bonus depreciation. A lot of people already know that with the one big beautiful bill, 100% bonus depreciation is back and it's back for the next 5 years. So if we buy anything now, we can write off the whole thing in that year. So some people rely on this as a year-end tax planning tool. Hey, I'm just going to buy some more equipment at year-end. I mean, if it makes sense, it makes sense. If it doesn't, it doesn't. You want to make sure you're going to make money on that equipment if you buy it. Your, your retirement plan limits change every year. They adjust annually, and it affects how much can be, um, uh, oh boy, hang on. Affects how much can be contributed and tax deferred. The rules for HSA insurance premiums and benefits are changing. HSAs are going up. There's also the HRA now that can work with several dentists, which is like a health reimbursement arrangement instead of an HSA where you won't have to provide, you can just put money aside from your employees and they can go to the exchange and get whatever life insurance they want, right? So that could be an interesting opportunity. Um, and some of this can affect the deductibility of personal family healthcare costs, right? Business expense rules change, meals, travel, CE, home office deduction and policies vary. What's deductible this year might not be deductible next year. So something you got to think about it. Credits and incentives. We have education, energy, or hiring credits can phase in and phase out. There are opportunities for training credits. There are opportunities for other credits that you can get from the federal and state governments that can be very, very interesting. Okay, dentists before the one big beautiful bill. I want to talk about this is a major, major bill. Okay. Tax law to this extent does not change very often. I mean, we had a change in 2017, and now 8 years later, we have a change in 2025, right? Uh, and before that, I think that the last change before that was probably the Affordable Care Act under Obama, right? So and that wasn't really so much as a tax change. It did have some tax impacts. There's no question. Not as big as this or 2017, but it is going to have an impact, right? Um, Dentists were operating before the one big beautiful bill. Dentists were operating under a tax code that was outdated, restrictive, unfavorable to small business owners. We were looking at bonus depreciation being scaled down. We had high self-employment taxes, right? And there were some provisions of the 2017 tax reform that were going to expire at the end of 2025, right? So 2026 was going to be very, very different. Um, the challenges was outdated tax brackets. They're changing the limited SALT deduction, which was 10,000, now 40,000. Sunsetting of the 2017 provisions were going to cause a lot of uncertainty, right? We weren't sure what was going to happen. No special treatment for benefits, right? Overexposure to self-employment tax, minimal access to credits, and then reactive tax prep. I mean, a lot of CPAs and tax preparers just prepare and they don't do any planning. Okay. The one big beautiful bill for dentists. What does this bring to dentists, right? We're going to talk about some of these impacts: deductions and taxable income adjustments, credits and accelerated depreciation, practice growth and expansion opportunities, hiring and workforce development, IRS compliance and risk management. So, um, I'm going to run through these pretty quick. I mean, we don't have all day. Unfortunately, if you want to go over the one big beautiful bill, we could take several hours to do it. I think I've done a couple webinars on the one big beautiful bill that really were amazing, right? I mean, in terms of the amount of time that they took, right? Um, so CE, we have expanded deductibility of CE and compliance, right? So like licensure renewal, infection control upgrades, clinical software subscriptions, all of which are currently limited under and capped under standard tax rules, have been alleviated, and you can take more of those deductions. Dentists earning under 350,000 would benefit from increased deduction limits for SEP IRAs, solo 401ks, and simple. Those have been raised. Matching contributions may qualify for the 10% payroll tax credit. Could be very interesting. Pass-through income exemption for healthcare. This provides a 10% exemption on qualified business income for dentists operating as S corps, stacking on top of the current 20% QBI deduction. So there's some pretty interesting stuff. Dental investment credit, 15%. Credit on purchase of digital dental equipment, increasing to 20% for US made goods. Accelerated depreciation of equipment. We're back into the 100% bonus depreciation. And the Green and Safe Practice Grant Program, you have some tax-free grants for eco-friendly upgrades and infection control technologies that could be interesting and give you a way to pay for some of those upgrades. Uh, uh, you know, startup and expansion of deduction enhancement. They've raised the startup deduction from 5,000 to 25,000. If you're planning to open a new office, gives you a little bit more to write off. Payroll tax deferrals. There are some payroll tax deferrals for small dental practices. Um, if you want to defer some of your employer side Social Security tax up to 2 years during economic hardship, you can do that. It has to be economic hardship, public health emergencies, giving practices additional cash flow flexibility. Workforce development incentives. We got grants, tax credits to practices hiring graduates from accredited dental assistant and hygienist programs can also be a big help to businesses. It can reimburse part of the cost of doing that. And then, the audit protection and safe harbor rules create standardized deduction protocols based on ADA benchmarks that reduce audit risk for dentists operating as S corps or partnerships. Practices that fall within acceptable deductible ranges will receive reduced IRS scrutiny. Kind of interesting. And if you're in some of those expected ranges in terms of percentage of sales or what they would expect, they're not going to come looking at you, right? So, but I think the IRS in general has already announced that they're going to have to restrict their audit activity. Okay. Um, and then after that restriction of their audit activity, that they made this public announcement because they don't have enough staff. Trump laid off another 25,000 IRS workers. So it's going to be even more difficult for them to go out there and really do the audits they want to do. And I think that's part of the reason. I think that's part of the reason why they put that in the bill is because you know, I think the IRS looks at dentists as pretty accurate in terms of what they do. And you got to remember, yeah, I told you that they audit 4.7% of self-employed, right? But S corporations, they audit less than about 1%, maybe less than 1%. So you're almost 5 times more likely to be audited as a sole proprietorship than as an S corp. Okay. Again, CE and licensing, great, fully deductible with expanded scope, bonus depreciation under equipment purchases, additional 10% pass-through exemption, retirement planning, you have higher deductible limits, staff hiring, some tax credits, practice startups, $25,000 cap instead of 5,000, some, optional deferrals on payroll taxes, the employer side, IRS risks, safe harbor rules, reduce audit exposure. And then there's some additional federal grants support on sustainability. What changed? Tax brackets. 2017 tax brackets made permanent or indexed. Temporary rate salt cap deduction, which a lot of dentists really hit, was 10,000. Now it's 40,000 on taxpayers who make less than $500,000 a year. Section 179 bonus depreciation, permanent 100% expensing of qualifying equipment is allowed under 179, and that's been raised. And then you can take bonus depreciation. Your QBI pass-through deduction that was set to expire actually under the 2017 law has now been made permanent and has been increased. Retirement benefit and deductions are higher. Additional deductions for we have tips, overtime, and auto interest that happen. I mean, and the interesting thing about the overtime, which you may be getting questions from your staff. So why isn't my uh, paycheck stub changing? I got all this overtime. It's supposed to be tax free. Well, they can write off a certain part of their overtime, $25,000 of their overtime if married filing joint. But you do it on your year-end tax return. So essentially, they're not going to get it back in each paycheck, but at the end of the year, they should get a bigger refund. Okay. Standard deduction, 16,750, and 33,000 married filing joint. And really, now we have with the bill and the last thing in the bill, we have more long-term predictability across key provisions of our tax code, which is great, right? So, real life financial impact, tax savings for dental practice, 350,000 in profit, full expensing plus QBI, and elevated deductions can lower taxes by 20 to 40,000 annually. They can help you with your take-home pay. You got a higher SALT cap, so you can write off those state taxes against your federal taxes. But you got to do some strategic planning, right? To make sure you can take advantage of the things. And really what happens is you change your numbers, right? And you change the way you do things to make that happen. Um, After implementation, I think we've talked about all this stuff. So 100% bonus depreciation is a great one. The 20% deduction plus for pass-through entities, new deductible caps, and everything else. I think we've kind of all covered all of this stuff already. So don't want to repeat things. Okay. Now, um, this is kind of broader. This is kind of things I've been thinking a lot about. The government has done several things. We have the One Big Beautiful Bill as a tax reduction strategy. We're doing things where we're restricting immigration. We are trying to get tariffs equalized, which may increase our costs, right? Um, and now the government's working very, very hard on deregulation and also to get interest rates to go down. And it looks like interest rates are going to start trending, right? So just from the One Big Beautiful Bill, we're expecting a modest boost, at least the economists that are the experts at calculating all of this stuff, right? Um, Hang on here, went backwards. Are expecting a 1%, a 4.4 to 1% increase in GDP, more economic activity, people having, this is by the Dental Tribune USA Budget Lab at Yale, are expecting a little bit more growth, okay? But they think that the growth will be in the fade as higher deficits can lead to rising interest rates. And, we're really looking at, the long term, some scary things going on with GDP and national debt and so forth like that. But, in the beginning, we should see some pretty good opportunities. You might benefit from faster adoption of upgrades, right? Software, digital, all of the other different things you can do with tax agility and investing momentum. We could in 2028 to 2035, sorry, see higher borrowing costs perhaps, okay? Hopefully the interest rates will come down in the near term, and then long-term industry-wide growth may decelerate. Dental practices need to build resilience, and one of the things what I talk about savings is an important part of that. Um, Access to capital, short-term stimulus encourage investment, but borrowers should watch for rising interest rates in the future. Patient demand. If we have a GDP uplift, right, and people have more money, there's more activity, people will want to do more, and it should drive some more demand on the dental side. Um, you also are looking some potential tightening with Medicaid and healthcare budgets could affect access and reimbursement for low-income patients. Dentists should monitor local Medicaid policy shifts if those are happening. Long-term planning, you know, uh, economic tailwinds that the economists believe that they may likely fade, making retirement planning, debt strategy, and business diversification more important than ever, right? Conclusion, uh, really what we want to do is, and I think this is a good way to put it, turning information, your books and records into financial transformation. I mean, the one big beautiful bill is going to help you, right? But really understanding your numbers, right, is understanding your business, right? And really being able to take advantage of that understanding to expand your business in different ways is very, very important, right? Thank you very much. I think we can go to Q&A now, if we have any Q&A. Okay, so Florida hosts and panelists, what do you suggest is the best retirement plan for a solo doctor practice set up as an LLC with an S corp election? Um, you know, um, I think like a SEP IRA or a solo 401k are certainly ways that you can go. I think those are pretty simple, pretty basic. They generally tend to have a lower cost. And like I can recommend some reputable retirement service providers. In general, I work with Guardian Life Insurance, which also does financial advising and things like that. You just want somebody that's going to provide something for, in your particular case, something that's fairly reasonably priced in terms of the overall costs and gives you the most amount of flexibility in terms of investing. Solo 401ks um, give you a little bit more flexibility in what you want to invest in, right? Um, okay, so what is considered reasonable salary for an S corp as a solo dentist? Reasonable comp usually can be somewhere around half of your overall profit. And usually most people use as a rule of thumb, um, kind of the half. Sometimes people go 40%, sometimes people go 60% of your profit. Um, you can do, and one of the things that can be done is a reasonable cost study to satisfy the requirements, sorry, a reasonable compensation study to satisfy the requirements of the IRS. And that takes into account, you know, your, where you live, what your revenue is, what kind of business you're running, and everything else like that. They're pretty extensive. They cost money. Rule of thumb, I think, if you're at 50%, you're going to be fine. The key is on your S corporation, you have to have officer compensation in line seven. Okay. If you take zero officer compensation, because you're required to take compensation for the service as an officer to that corporation, that was decided a long time ago. Actually, a CPA tried to mess with that with the IRS and he got himself in trouble. And that was the court case that established this for the IRS. Of course, it was the CPA that did that. But if you have something in box seven, you've established a position, right? And if you're looking at half of your profit as your wages, you know what? They're not gonna push you hard because you've taken a position. If it's zero and you're taking no position, the IRS is gonna say all of your profits subject to self-employment tax, you owe us all this money. They're gonna fine you and they'll double the self-employment tax. It's 100% penalty. So you want to do this. Definitely want to do that, okay? Meals usually provide my team when hit our goals. Well, no. Okay. So Jen, man, meals that you give to your employees, right? Or snacks that you buy for your office should be under employee benefits and not meals. Okay. Those are just employee rewards that you do. So, a lot of meals are no longer deductible. During COVID, they deducted all meals and everything to get people to spend more money at restaurants. But um, those are really employee benefits. And when I do the books and I counsel my clients to say, hey, if you're doing something for your employees, so a great example is, I mean, I do a Costco run every couple of weeks and buy a bunch of stuff for my employees, snacks, coffee, whatever. Sometimes healthy stuff, sometimes not healthy stuff, but that is an employee benefit. And that's something that you can definitely do for your employees. So you should definitely be writing those off as like employee benefits or incentives. They're de minimis incentives. Each one of those meals is less than 25 bucks. Okay. Usually, and it's like de minimis and it's not a problem. You're not required to put that on a W-2 because it's de minimis and it should be fully deductible.